If you ask any professional investor what they're looking at right now, they're probably gonna say gold, and why wouldn't they? It tends to move in times like these, but what they really should be looking at is yields. Yields were up and stocks were down as the market sold duration assets after a vicious move in gold. And the question on everyone's mind, what is gold telling us? But the more important question is, what does the recent move in yields mean for stocks? Today, we discuss that and where to position yourself if yields continue to rise. We're also going to be talking about valuation and what the big funds are buying and why they're buying it. So with the S&P 500 trading just off its highs, is this a dip buying opportunity, or is this the start of something much more sinister? We've got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers. Pretty red day across the board after some ugly action in gold and yields, rates, bonds, and that led to, well, the market just selling. It was actually just a liquidation, a pure, let's build up some cash into April. I mean, look at stuff like utilities, healthcare, even telecom services, very, very mixed or in the red. The only real defensive sector was energy, and this is more of an inflation hedge more than anything else because these companies have a ton of debt on their balance sheet. But other than that, it was red all around. Real estate, the worst performing sector. Financials red, cyclicals red except for Amazon. The only parts of the market that were green was semiconductors here, and then the big boys, Google, Meta, Microsoft, Amazon. Look at stuff like Berkshire, pretty much flat for the day. There was no defensive rotation today. It was just a liquidation. It was just like, sell assets. I'm going to go collect my 4% yield in a money market. Now, actually diving into sectors that did the best. I mean, semiconductors up 1.31%. GDX. By the way, these are my top sector picks for the month. So to see them outperforming the market, really, really good. Look at this. It was the big boys. Besides energy, it was technology, comm services. They put out the best. Metals and mining did do a good day, actually, in hindsight. But other than like these sectors right here, everything else underperformed the SPY. The SPY was down for the day. And to actually see like technology and semiconductors up and the SPY down shows you how deeply red it was underneath it all. So yeah, just a day of liquidation today. So why did the market fall today? I mean, it's very, very simple. So gold rallied pre-market and the market took that as safe haven buying. Safe haven buying is risk off, okay? Then yields also spiked today on good data. We got good economic data, good PMI data, and as a result, because of yield spiking, stocks liquidated as a result, just because of the duration trade. And so everything combined with the risk off nature we were seeing in the gold market, as well as yield spiking, that led to a liquidation. And that's why stocks moved lower today. Let's hop on the charts and see what it looked like on the S&P 500. Now guys, the Nasdaq was the only positive index for the day. It gained 0.21%. The SPY lost 0.2%. The RSP fell heavily, 0.59%, despite what technology did. Then we had mid-caps falling 0.7%, S&P 600, IWM down both a percentage point there, 100 basis points. Very rough day for smalls as well as mid-caps for the most part. A slight after-hours bid here in futures as well as the IWM. So, a little bit of strength coming into the market, but yeah, pretty red day across the board. And I think that's going to follow into the Asia session, into the Europe session as well. And then we'll see what the US does tomorrow. Bitcoin continues to struggle at these highs right here. They just haven't been able to hold above 70,000 for the most part, and haven't been able to get these all-time highs. Then we actually go ahead and have a look at gold, closing the weekly candle, even though it's just Monday at the highs. Looking at the daily chart, yeah, new all-time closing high, the highest closing high ever in gold. And markets were just a bit spooked by this move right here, and that's why we saw the price action. Now looking at the S&P 500, zooming into the daily chart right here. So the line of the week we're looking at is this low right here. That's what we're looking at. So simply because we kind of used it as resistance right here, there's a bit of a gap, and then we used it as support right here where we bounced last week, middle of last week. Now today we had a tiny gap up, had price discovery above, price discovery low, finished sort of in the middle of the bar. So after how red it was, like midway through the session, you thought it was going to be a very red day, but the bulls did come in at the end of the day. Hopping on the 5-minute chart, let's actually have a look at everything. Couple of things I want you guys to know. Firstly, we had this massive red candle, right? That actually brought us all the way back to pretty much the highs of the day, and that was on some macro news. And that was actually ISM data. We got the ISM data for March, officially the first time of growth since 2021 right here. Very, very interesting data points. Manufacturing PMIs have bottomed. This is going to really help industrial stocks, and the market actually really did like that. You can see we had this massive volatile candle at 11 when the data was released, but we parred all of those gains in a single 5-minute candle. So it was just a lot of like algo buying and then algo selling all the way back down. We did see quite a lot of buying towards the end of the day right here. We sort of formed this double bottom and then rallied. And something I do want you guys to note, look at long duration yields, TLT down 2.19%, right? That means like the 10-year yield, the 20-year yield had to rally anywhere from 2 to 3% in that time period, right? So yields were up 2 to 3%. TLT was down 2.19%. We then look at the aggregate bond index down a single percentage point. By the way, that's a big move for bonds. Bonds are not supposed to be that volatile, right? And at the same time, you have a look at something like the S&P 500 was only down 0.2%. Look at the Nasdaq 100 up 0.21%. So bonds and yields made a massive move today. Gold was up, and the S&P 500 and the Nasdaq kind of just brushed it off. I know the broader market did take it on the chin a little bit, but the market for the most part brushed it off, especially in large caps. Mid caps and high beta, small caps didn't do so well. But I do think like when you have a big move in bonds like that, especially after a month of pretty much nothing happening in the bond market, you think there'd be a bigger move, especially in the larger names, and there simply wasn't. So I think what the market's going to do is buy this dip. I think that's what's going to happen over the next couple of days. We might have one more red day, but we already saw some buying today. We got a wick right here at the bottom of this red candle, pretty strong wick, and I do expect buying to continue. If we do continue moving lower, look at this 5202 level. This is the big level we're looking at right now, 5202, this line right here. And yeah, if we pull back here, I do expect us to find support at this level. We could just rally from right there, but what everything's telling me right now, I think we should probably just move higher into tomorrow based on the buying we saw here at the bottom. And for the most part, at the end of the week, we get buying at 5202. This is what dealer supporter flows look like. You know, we buy dips, sell rips, and we get a lot of like very supportive price action despite what stuff like yields and gold is doing in the market. What is going to affect the market though is if bonds keep selling and yields keep rallying. That will affect the market drastically, particularly here in small caps, mid caps, and the RSP. If yields keep moving higher, that's going to have a major effect on the market, and then we might see a rotation back to value and high quality and companies with great balance sheet. But as it is right now, we're just looking at a red Monday after what was a pretty positive week, and we're still well above our line of support here at 5202. We could pull back to here, still be 100% bullish for the week and look to higher price action, look to all-time highs, or we could just rally from here. I do favor just a rally tomorrow unless yields start acting up. Now guys, the weekend poll just wrapped up. 831 of you guys voted. Thank you so much to everybody who voted, and we mixed it up this week. We actually added 3 selections, bullish, bearish, neutral, for the question, what is your sentiment for the S&P 500? And I do like the third option because it gives us more visibility as to where we stand in this community. And right now, 47% of you guys are bullish, 32% of you are bearish, and 21% of you are neutral. So still very, very bullish, and we still have a lot of bears in camp, which means we probably go higher. We need every single bear to capitulate before we could actually really get an extended form of sell side. And I'm going to show you bears capitulating later on in this video. But for now, this is the sentiment, but let's actually have a look at some stats. Now this right here is some very interesting data. It's when stocks stay above the December low in the first quarter or stay above it during the first quarter, and what are the returns in the final 3 quarters and then the full year. Crazy interesting stuff. And generally speaking, if we're above the December low, good things tend to happen. Look at all this green, right? Versus if we actually break below the December low, the returns aren't as great. We could see an average return 12 months later, 18.8%, positive 94.6% of the time. The only years that were negative was 2015, 2011. Whereas if we actually break the Q1 low, we normally actually get full year returns pretty much flat 12 months later, down negative 0.2%, median negative 0.1% and only positive 48% of the time. And we haven't broken the December low. We're actually well above it. And even though we've rallied based on this data right here, we can expect higher price action in the S&P 500. But let's actually look at valuation, because we have run up quite a lot and valuations are looking very stretched. Now, this is some valuation measures right here. Based on the forward PE, the S&P 500 right now is at a 21 times. On a Schiller PE, 34 times. Very expensive. This is what we were at the 2021 rally. Very close to like 22, 23 times on a forward PE basis. Now, looking at dividend yield, the S&P 500 returns 1.43% to shareholders, a price to book ratio 4.23 compared to the average of 3.12. Look at the price to cash flow, 15 times versus 11 times, and then the earnings yield spread of negative 0.97%. So on every single metric here, the S&P 500 is overvalued. And what does this normally mean for returns? Well, it's not necessarily a good thing. Based on forward PEs where we are right now at a 21 times, the 1 year subsequent returns is looking like a 2.3% from here. And then the 5-year annualized returns is looking at 3.6%. This is based on historical data. And you can actually see normally when we get to these PEs right here, 2021 plus, a lot of the returns we do get in the next 12 months tend to be very negative. Not so much in a 5-year period, but that's why when index valuations get to this point right here, it's best that you start looking at individual names or maybe trying to find ETFs that are not quite as richly valued. So just some data there for you guys with regards to price to earnings. Now let's talk about fund flows. Last week we saw $15.36 billion worth of equity inflows. This was coming off a down week of about roughly the same. And then the week prior, which was the biggest inflows we've seen, I think in like 5 years, crazy amount of inflows. We saw nearly $52 billion worth right here. So people are still buying equities after what has been so far a very positive year of inflows for equities here in 2024. Now, this is what people are buying. So ETFs saw a pretty big inflow. We also saw technology, comm services, and industrial inflows last week. And then what people were selling was stuff like financials, discretionary staples, energy. So more of a risk on move in the last week. Now, when it comes to long only funds, so pretty much the big boys, what are they holding? What are they buying? Well, they're buying the Magnificent 5 plus GLP-1. They're overweight those significantly. And you can see here that they're buying Meta, Lilly, Microsoft, Amazon, Google, and Nvidia, and they're not really buying Tesla or Apple. And this is relative weight to the S&P 500. And the reason why long only funds like these names right here has to do with growth. Have a look here. Earnings growth, pro forma EPS for the Mag 7, 37%. That is why long only funds are overweight them versus 3% ex Mag 7. And we actually see continued earnings growth expectations for the rest of 2024, 24% here for the Mag 7, 14%, and then 15% again in the fourth quarter. And that's actually kind of crazy growth, but we do start to see the 493 earnings pick up and outpace the Magnificent 7 in the fourth quarter. Looking at performance dispersion, so far year to date in 2024, the worst performing Magnificent 7 name is Tesla, down 29%. The best performing is Nvidia, 82%, and then the average here is about 10% return for the year so far. And guys, you get a 10% return in a single quarter. That's not bad at all. That is not bad at all. And in aggregate, on an equal weight basis, you can see here the Mag 7 has returned 13% year to date, mostly by gains from Nvidia, and they're actually beating the S&P 500 by 10% and the 493 by a large margin. Just for the record, my undervalued portfolio is outperforming the Mag 7, the S&P 500, and the 493. So guys, go and check out my undervalued portfolio because I still think it's going to do really well in 2024. But guys, large cap growth is not the only play in town. If we are to get significant rate cuts or even a pause longer than the market expects, the best place that we could possibly be is actually large cap value. It's a hedge against duration risk. If rates settle higher for longer, duration risk matters. Large cap value is the shortest duration index. And typically speaking, if rates are to stay higher for longer, let's say we don't get these cuts in June that we are expecting, large cap value is going to make a comeback in a very big way because it's not overvalued and they're delivering absolute value to shareholders in the form of dividends, share buybacks, and you're getting it at a very good price versus long duration assets. If rates are to stay where they are, that could really affect growth sensitive assets. And generally speaking, in periods of high interest rate environments, value does outperform growth. You can see here that US Treasury rates between 4 to 5%. Value outperforms growth. More than 5% value continues to outperform growth. It's really only here in the 3 to 4% range and 2 to 3% range of the US 10-year that we really start to see growth outperforming value. That being said, you're still getting a 15% return year in growth and 16.2% in value. So hold equities. Now let's switch gears, guys, and talk about a comment I got in a video yesterday. Now this was from Robertson X05EB. We're going to call this dude Rob, right? He pretty much said, anxiety emoji. I am finally long, been bearish since early 2023, lost 40% of my capital shorting. Oh my goodness. I took some S&P 500 longs at close on Thursday. I love your content and unbiased approach. Thanks, Chase. Guys, so Rob right here didn't believe the rally. He was a bear. He was short, lost 40% of his capital. That's so sad. And he's now capitulated long. And the reason why I wanted to put this out here is just to give you some advice, Rob. Number one, at the end of the day, what happened in the past happened. What matters now is the future. And yes, you bought the top in the S&P 500, but does that mean it's a bad investment? Not necessarily. This is the S&P 500 returns at all-time highs. So we can see here all-time highs and market floors. Now this is since 1950. Percentage of days S&P 500 closes at all-time highs, 6.6% of the time. Percentage of all-time highs that act as market floors, 29.9% of the time. So even though you have bought the top essentially, what I would recommend to you, Rob, is you dollar cost average into the position, okay? So don't just buy today, buy next week as well, the week after that, the week after that. And if we do get a pullback, that's an opportunity for you to buy. Because you can see that the average cumulative S&P 500 total returns, 1988 to 2023, invest on any day versus invest at new high. You can actually see that in 3 years, invest at new high actually returned more than invest on any day. I don't know how that works, but this is JP Morgan Asset Management data right here. And you can see that investing at an all-time high, even just 3 months later, 6 months later, 1 year later, normally returns a positive figure. So dollar cost average, buy every week, Rob, and you should do really, really well. And it's going to take you a while to recoup a lot of those losses. However, the beauty of the Western tax system is that you can write off all your losses against future capital gains. And now all you need to do is use this experience as a learning tool. A loss is not a loss, it's a lesson. And any lesson is a blessing. That's Jay-Z. And the best thing you can do from this situation is just learn from your mistakes, move on, move forward, onward and upward. Now, looking at gamma, we are officially out of the window of weakness. We are in positive gamma, so that means all dips need to be bought. You want to buy dips, trim, sell rips, making your way higher to the 5300 strike. That is the rules of engagement as long as we're in positive gamma. Now, 5200 right here is the gamma flip zone. It is really moving up the tape, but so too is the S&P 500. It is moving higher, and that is why the gamma flip is moving higher. Now, we're in this April period. It tends to be a very bullish period on pretty big volume. We have run up quite a bit, so we do want to pay attention to a couple of things. If we do get below the gamma flip zone, I really do think based on momentum seasonality, we can really see some downside. Something to note, there's a lot of positive gamma at the gamma flip zone. So this zone right here, 5200, is going to be very, very hard to break if we do get there. However, if we do break below, I think we will see material downside, particularly knowing that the momentum factor is negative in April, and the momentum stocks are the biggest stocks. We're looking at tech, discretionary, semiconductors, comm services. Those are the momentum based stocks, and if they start moving lower, the whole index and the whole market will start moving lower. That being said, we are in positive gamma, so buy dips, sell rips all the way to 5300, and until the strike moves up, that's our target for now. A lot of gamma is being built up here at 5400, and there's a lot of support on the way down. And until something materially changes, we're going to buy dips, we're going to sell rips all the way to 5300 and beyond. Now, March just wrapped up, guys. We're officially in April, and this is April seasonal performance. According to history, since 1950, this is normally what April looks like. So you can see a bit of sideways action here for the first couple of trading days. Then we normally do ramp up, making higher highs, higher lows, all the way until about OPEX. This is about OPEX here, a little bit just before it. I know there's no dates at the bottom. And then we normally do trade sideways in April, returning upward of 2% for the month of April. So generally speaking, you want to be long in April. I do know the momentum factor can produce can throw a spanner in the works. However, we do have to look at history. We do have to look at the data, 70 years worth of data. And normally April is a very positive month. Now let's look at some trade ideas. Now looking at some trade ideas, this is Taiwan Semi, ticker TSM. Now firstly, since October, we've been on this massive uptrend, making higher highs, higher lows, as you can see right here in the stock. However, what's happened is we've put a high and we have traded down in the last 2 weeks, as most semiconductor names have pretty much gone sideways or up. TSM has underperformed the semiconductor market. Now we are coming to this area right here where we found support right here. And we're also trying to find support. This was the same area we used as resistance in early February. Now, what I want to see TSM do is find support at this level. If we do find support, you can enter long trades looking to break all-time highs at 160, and you could put extremely tight stops here at the 128, 127 mark, and that's a great 4-to-1, 5-to-1 risk to reward here in TSM. Very similar trade in AMD. We're on this long uptrend, higher highs, higher lows, very similar trade. We've traded down in the last 2 weeks. I want to look at this low as being a significant low, find support yet 172, make 160, maybe 161, 162 your stop loss, and look to something like 200, 210 as a potential target, maybe even these all-time highs, and that's a 5-to-1, 6-to-1 risk to reward play there in AMD. Very similar to TSM, especially as AMD is consolidating here or found support in this congestion zone where we previously found pretty big support. Now looking at a sector as a whole, gold miners, ticker GDX. This was my top performing sector for March, as well as XLE Energy, and I do think we're going to see continued outperformance in GDX. You can actually see we sort of are in an uptrend, I guess, because we haven't made a lower low. We put a low right here, higher low, and another higher low. We haven't been able to break these highs, and that's the thing. But I do think that there is still upside left here for GDX, and if we can go ahead and break this 32 mark, we can then look at 35. If we break these highs, we can then look at this level right here. So material upside for gold miners. Now on the daily chart, you can actually see that this month we broke above the 200 SMA, and that means we probably do go higher here in this trade. What we really need to go do is break above these highs, especially have a close, maybe even a weekly close above these highs and then above this high right here. If we go ahead and do that, we can then look to 35 as the next higher target. Do manage your risk effectively, guys. I would maybe put stops here at the 200 moving average, maybe just below, and look to prices as high as $40 here in GDX, especially if gold starts to ramp up and we do get those rate cuts. I do think we're going to see a massive re-rate in gold miners. Now looking at data in the week ahead, guys, so everything is going to come down to this employment data. JOLTS is going to be a big one, as well as ADP employment, initial jobless claims, and then the non-farms and unemployment figures here on Friday. Guys, but if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.